they should just let them have Taco Tuesday and start calling it Tacos Tuesday. That way, people will start thinking in terms of multiples, and they'll drive up revenues. No, really, it's kind of like back in the. Did you ever read the Sales Bible by Zig Ziglar? He gave an example like back in the day during in soda shops, milkshakes. He goes up to the milkshake person. He says, "Hey, I have this bright idea, but if I give it to you, I want 10% of all the additional profits." And his idea was, instead of asking people if they wanted an egg or no egg in their milkshake, he said, "Do you want one egg or two eggs?" And then profits just skyrocketed because people were now like, "Oh, I guess I'll just have one." And now they got all the people that wouldn't necessarily want an egg. So yeah, call it Tacos Tuesday. Maybe that should be a thing.
All right. Welcome to episode 88 of Farm to Markets. This is the show where participants only get 5 minutes to state their opinions, and the person with the most time at the end wins, but there are no prizes. Today we are talking about why economic growth remains high despite Fed tightening, psychedelics, Twitter Financial Sentiment Index, shopping music, and the baseball pitch clock. The world's central banks have raised at an extraordinary pace over the last year to cool inflation, but it hasn't proved enough. Economic growth remains mostly solid and price pressure strong across affluent countries despite sharply higher interest rates. Why haven't growth and inflation slowed more despite their efforts?
Well, I think there are a lot of different reasons for this. I will go over a handful of them that I think are pretty important. First of all, you still see a lot of global supply chain disruption everywhere in a lot of different industries. This is becoming a feature of global trade and not a bug anymore. The era of free trade as you know it, I've mentioned multiple times, is likely ending. And you're probably seeing more regional trade blocks or countries trying to do things more and more at home or with their immediate neighbors than they are trying to find the cheapest possible thing halfway around the world. One instance is this: is semiconductors. The United States is intentionally trying to bring this industry back to the United States, and you're seeing that disrupt the entire semiconductor industry and all the supply chains that feed it. Another one is to watch over the next month is the Turkish-backed wheat export deal between Russia and Ukraine that also covers, what do you call it? Components of fertilizers. If the Russians do not renew the deal, and it sounds like right now they're leaning against renewing the deal, but they still may, then that will cause problems with both food and fertilizer markets. Second issue right now is we have wage-driven inflation. Baby boomers are retiring, and there aren't enough Gen Xers to replace them. And when you need somebody with 30 to 40 years experience, and there are 40% fewer in the market over a 5 to 10-year period, that causes wage increases. At the same time, when you have a lot fewer low-skill, low-education workers, because immigration to the United States has been pretty rock bottom for the last few years, that puts pressure on wages at the bottom of the economic ladder. And third and finally, we've talked about this in the past, everybody is borrowing and spending like there's no tomorrow. We see households, businesses, the financial sector, governments are all borrowing and spending like crazy. So spending hasn't really slowed down all that much, and debt is going through the roof. So I'll go ahead and end there to save some time.
I think Alex did an excellent job of peeling back the onions. There's a lot of things going on in the economy that are the answer to that. I think he said it pretty succinctly. So I'll just give my quick and dirty answer. And I guess that's just, we haven't thrown enough water on the wildfire to put it out. In other words, we haven't raised interest rates high enough or fast enough to get ahead of this inflation wildfire. Remember, in response to COVID, the government injected huge sums of money into the economy through stimulus. And it was predictable at the time, and it's quite obvious now that this caused high inflation in the economy. And the response to this high inflation, as we know, is to incrementally raise interest rates. Now, these interest rate hikes were small nominal interest hikes between like 0.25% and 0.75%. Now, while these nominal rate hikes did and do affect the rate of inflation, it's not enough to have a big impact on inflation. The real interest rate, or the inflation adjusted interest rate, was just like sprinkling water on a wildfire. The Taylor rule in economics suggests that the interest rate needs to be raised 1.5 times how much inflation exceeds the Fed's target rate, which is 2%. Well, let's just use last year as an example. We had 8% inflation with a 2% target. That means the Fed needed to raise nominal rates at least 9%, not 25 bips. Granted, a huge rate hike like this would probably sting the economy pretty good, but theoretically, I'd rather douse a wildfire quick and abruptly instead of slowly putting it out while watching thousands of acres burn. And that's the answer to the question why growth and inflation hasn't really cooled.
You know, we as consumers, we tend to have a pretty good appreciation for the effects of higher interest rates. But what we really don't understand is the effects of reserve requirements on banks. And quite frankly, we have not raised the reserve requirements up enough to really have a meaningful impact on our economy. Is that virtually for years, the margin or the reserve requirement for banks was virtually zero, which means they could lend out all the money they had in the bank and then essentially create new money out of thin air with those monies. Well, if the problem with inflation is there's too much cash floating around the economy, and the Fed has done a pretty slow job, if not a poor job, of getting that excess cash out of the market. Raising interest rates certainly helps, but if you want to do it quick, increase the reserve requirements. And when they do that, then we'll really see this. We're having this conversation today. It'll be interesting to see what conversations we have 6 months from now, because as we discussed a few weeks ago, people are starting to live on their credit cards again for the first time in a few years. When that happens, we're really going to start seeing some rumbling in the masses. So overall, I think that the Fed's been too slow to get a handle on inflation, and the result is we continue to grow and inflate.
So like in Europe, they basically did this thing where they anticipated that they're going to have extremely high gas and oil prices over the winter. And as a result, they were going to give everybody like a stimulus check to like offset that. So they're essentially going to try and hit the gas and the brake at the same time. Well, is that they didn't have extremely high gas and oil prices. So they're basically just hitting the gas without the brake. And so they have to, continue to increase their interest rate to try and slow what they'd already planned on doing. So that's one reason. The other thing I found surprising, though, is that everybody's like, everybody's taken out a lot of debt. But the St. Louis Fed published a chart this month that showed that household debt service payments accounted for 9.6% of disposable personal income in the first quarter, which is the lowest levels recorded since 1990 through March of 2020. So, it's kind of contrary to one thing. One thing is that it doesn't appear that we're taking out as much. Maybe we're taking out more debt, but compared to disposable personal income, that amount is actually lowered. So people are either making more money, or something's changing where compared to personal disposable income, the amount of debt that Americans have is declining, which has like two things. One is that it probably means that they have more disposable income to spend in the economy, which is a good thing, and obviously, if they didn't overextend themselves during the pandemic, they have more room to go out and buy things or take out loans at higher interest rates now than they did before that. So I just thought that was kind of interesting because we just talked about how credit card debt was surging, but apparently, according to compared to disposable income, levels are actually dropping. So I thought that was kind of interesting. But
was that the payments they're making?
It says
the debt, or is that the debt levels itself?
It says house. So this is from the Fred economic data, which is basically the St. Louis Federal Reserve data. And what it says here is household debt service payments as a percentage of disposable personal income. So
those statistics can be somewhat misleading in a diverse population of people with lots and lots of disposable income, and other people have zero disposable income. But if you say if you mass it all into one big group and then divide by the number of people in that group, it sounds like relative to disposable income, you've got a lot less credit card use. But I think what really has happened is that there's lots and lots of people who don't have discretionary income using credit cards, and are being offset in this statistic with a lot of people who have lots of cash.
Right.
And I just wanted to double check. That's debt service payments, they said, right?
Yeah, you want me saying? I'll send you the link.
Because well, if that's the case, then they might just be paying the $35 minimum payment and letting it all pile up.
Yeah, it says. I mean, it says debt service pay. I mean, it could be. I guess it doesn't necessarily.
Yeah, I'd be interested to see. Anyways, we can move on.
Okay, it's just is ratio of total required household debt payments to disposable income. So, yeah, I'll share a link here. But anyways, okay, so there's that. So we'll go on to the next one here, which is routine drug use has moved from an after-hours activity squarely into corporate culture, leaving boards and business leaders to wrestle with their responsibilities for a workforce that frequently uses. At the vanguard are tech executives and employees who see psychedelics as a similar substance, among them like ketamine and LSD, as gateways to business breakthroughs. There are millions of people microdosing psychedelics right now, says Carl Goldfield, a foremost sales and marketing consultant in San Francisco, who informally counsels friends and colleagues across the tech world on calibrating the right small dose for maximum mindfulness. Is this the farthest path to opening, or this is the fastest path to opening your mind up and clearly seeing yourself for what's going on, says Carl. Do you think, how do you feel about executives microdosing?
I mean, I don't look at this any differently than, you look at people chugging a couple of mugs of coffee first thing in the morning to get going. I mean, we've been doing that for hundreds of years. In the early 20th century, everybody was on opioids or amphetamines, from, athletes to business people. In the 80s, I mean, you probably couldn't walk into a big business without stepping on a pile of cocaine. Now it's psychedelics. Everybody's trying to get an edge, and this is probably just the most recent chemically induced edge that people are looking at. I'm not surprised. I'm not going to condone it, but it just seems like it's the latest and quote unquote greatest way to get an edge in business.
I was kind of thinking of coffee as well, because I guess these microdoses, they're like 10 nanograms or something, where you don't feel high. People can't tell that you're under the influence. It's just something back there that helps you cope with the stress of being an executive, taking pressure from investors or VC firms, or coming up with new ideas, or maybe it's just the peer pressure of living in that world. Me personally, I'm perfectly fine with the way my mind is. I guess if my mind was a camera, the aperture is perfectly like open. It's not too closed. It's not too open. I don't have any major problems with other people being users. If using drugs really helps with their innovation and creativity, I suppose that having the Silicon Valley vanguard using drugs is kind of a good thing. I guess I just forget sometimes what a different world the elite in Silicon Valley live in. And products that were created in Silicon Valley, I guess, make my life easier. So I suppose I'm thankful for those people who do that, but it's not for me. I don't think I'll be ever microdosing at work to do my job.
I tend to lean libertarian when it comes to drug enforcement laws, and I guess I don't care whether or not the CEO of a Silicon Valley tech company is dropping LSD in order to improve his job performance. The problem is that what about everybody else in the organization who is also taking LSD? And all of a sudden you have all of these social problems that massive amounts of people using LSD can create on society. Is that one of the reasons that your healthcare costs are so high is because you're paying for the cost of the potential of going into a mental institution because of drug abuse. By law, the Affordable Care Act requires insurance companies to insure people for drug abuse problems. So if you were to remove the risk to the rest of us from having to pay for the social pathologies of drug use, I have no problem with it. But as it stands, if there's no way I can figure out where CEOs are allowed to pop LSD or drop LSD, but the rest of the rank and file can't. So therefore, I think that you either get rid of our requirement to be in the same risk pool as everybody else, or continue to have the drug laws that we have.
Yeah, I guess it's a slippery slope. That's what I'm concerned about. Like, I've never had a handful of LSD gummies before, but what prevents you? Is this like, what's the Queen's Gambit is a good example. They give you one of those little pills, right? And it's supposed to like help you, do whatever it's supposed to do, but then you're like taking fistfuls of them. I guess what's is it just because it seems like it's like a gateway. I mean, it's like you're right. I take a little bit of this drug, and then 2 months later you're taking 2 gummies, then it's 3 gummies, and now you're completely baked on acid, trying to do your job, and then you have a whole corporation of people trying to do that. Like, I mean, drugs are addictive, so I mean, if you're gonna do it, you got to be extremely careful. Like, I don't know, like if you microdose on it, if like how addictive it is, but I mean, you gotta have the utmost respect if you're gonna do that, because I feel like it's a slippery slope that once you get on, it's going to be hard to get off. So I would be just very careful. I echo the libertarian sentiment, but yeah, for me, I don't know, man. It just seems like you're taking a big risk there that you're going to get addicted to like LSD. So I don't know.
Well, we really haven't even addressed the other part of the article. We've addressed the microdosing to try to enhance creativity at work, but there was also the sub story of these tech CEOs having these rage parties at their house where the guests have to pay several $100s and sign non-disclosure statements while they're all dropping LSD and getting, and having these trips. So, it's okay to do it at work on microdose. Is it also okay to be having these LSD tripping parties with all of your, literati friends in the Silicon Valley?
I think if I was a tech CEO, I would if I was doing that, I would keep it as much of a secret as possible. And maybe they do, and maybe this stuff gets leaked. But when you're rich like that, you have the luxury to make bad choices without repercussions. But yeah, I kind of agree with you, Dad. If like the whole Google campus was tripping LSD because the CEO was doing it, now you have a real problem on your hands.
Yeah. All right. Okay, so number 3 is that so using data from 4.4 million tweets posted since 2007, researchers created the Twitter Financial Sentiment Index to track investor sentiment, whether users are feeling positively or negatively about financial conditions on the social media network. They found that the tone of tweets overnight between the hours of 4 p.m. and 9 a.m. Eastern Standard Time could be used to forecast the S&P 500 index's returns the following day. The researchers use a language model tool to assign a numeric value to each tweet depending on if the tweet most likely conveys positive, negative, or neutral sentiment. Now that goes into the Twitter Financial Sentiment Index, and the researchers found that an index measurement that is one standard deviation lower than usual overnight will lead to results. Excuse me. So if they find that the index is 1 standard deviation lower overnight, that leads to returns that are 6 basis points or 0.6% lower in the S&P 500 the next day. Put simply, when the tweets are more negative, that usually tends to precede losses in the stock market. Are you going to start paying attention to the Twitter Financial Sentiment Index?
I think if you're day trading the S&P 500, maybe. For now, I think I would like to see them refine their methodology and their research a little bit more, but I do think it's pretty interesting. I think it kind of confirms something that I heard a long time ago, that economics is sociology plus math. So you can look at the numbers all you want, but how people react to them is kind of a wild card on a daily, weekly, monthly, whatever basis. So yeah, it's worth paying attention to how people feel, because that can give you a better idea of what they will do with the information they're receiving. As far as should we make changes to our investment models based on it, probably not yet, but I think it's an interesting thing to keep an eye on.
Yeah, in case that was directed at our investment models, absolutely not are we using the Twitter sentiment index to make any of our investment decisions to any of our listeners out there. But this is fascinating. I do think there is some accuracy and precision in the whatever it's called, the Twitter sentiment financial sentiment index.
Yeah, Twitter Financial Sentiment Index.
Financial sentiment index. And like Alex said, this is probably most beneficial to day traders that want to take the gamble. And it's probably only effective right at market open based on the sentiment leading up to that. Once the market open, it's reflecting all information that's out there. And once new information turns up that you don't even know of, that's going to change the market. So if you're going to bet right when the market opens, then sure, yeah, that might actually be a viable strategy. This isn't exactly a new idea. In fact, this is just another example of it's called the wisdom of the crowd concept. And basically, the theory is the collection of a large group of human knowledge is more accurate and precise than that of one or just a few experts. And this has been used from a lot of applications. Is used from guessing the weight of a prize ox at a county fair, to finding missing submarines, to developing complex mathematical laws. So I think the theory is actually pretty cool. It probably does have some application, but just to say it again, not for us.
You had mentioned that 6 basis points is 6/10 of a point, but it's not. It's 0.06 basis points. So it's like a really, really small amount. Those 6 basis points can be eaten up by a whole bunch of other things. Now that the article talked about the 6 basis points on the negative side, but what about on the positive side? I don't think it's quite the same. So it's not something I'm interested in, because it looks to me that the amount of effort involved and the amount of success that you can actually derive from this on an after fee basis, the trading costs alone on the spread between the
bid and the ask.
in the trades, the buys and the sells, is probably going to eat up that 6 basis points anyway.
Okay, and I'm gonna have to double check if it was 60 or 6. Could be a typo. Sorry. Yeah, you're right. 6 basis points. Yeah, that is not point. That's 60 basis points. But this clearly says 6, and I basically just copied it out of the Wall Street Journal. So yeah, maybe it is 6 basis points. My bad. I thought it'd be more than that. I thought 60 basis points. I was like, sweet. Okay, that's worth it. But 6.
That would be enough to probably trade, but
yeah, 6 basis points. Yeah, that's not that great.
Just to be clear, 100 basis points is 1%. So we're talking about 6/100ths of a percent.
Yeah. 60 would be 0.6, a little over 0.5%. But they're saying 6, not 60.
It's less than 1/10 of 1%.
Yeah.
Oh,
Good. Glad we got that. Yeah, sorry, it is. Sorry, it is 6 basis points. You're right. That's what according to
okay.
Money. And this is also in the link to the studies. Yeah, so it's 6 basis points, not 60. All right, good catch.
Yeah, you could literally make tens of dollars.
Yeah. So it's not that.
In defense of the strategy for the people who are the high speed traders.
I know.
It might return into millions of dollars on billions of dollars of trades.
6 bips on 10 billion is probably pretty good.
Yeah. I don't know. Drew's right. It's also called the S&P 500. You want to know what everybody thinks the market's going to do? Watch the S&P 500. So, all right, moving on. Yeah, I'll read the study later. Okay, anyways, all right. Let's see here. So another study, this one from Sweden. So in a study based on 3 supermarkets in Sweden, researchers showed that background music did boost consumer spending, but only Monday through Thursday. The researchers looked at 3 supermarkets in Stockholm, serving in a total of about 150,000 customers over 3 weeks, during which the store switched between playing popular songs or elevator music in the background or playing no music at all. The type of music didn't make a difference on purchases, but Monday through Thursday, music encouraged customers to spend more. In a follow-up experiment, authors found that in one of those stores on weekdays, customers spent an average of $23.31 per person for each excursion, compared with $14.96 when no music was playing. On the weekends, however, the difference between having background music and no music wasn't statistically significant. Why do you think music makes people spend more in the background?
Well, I think it probably has to do with Monday through Thursday being much more calm and less stressful shopping days. On the weekends, people often decide to have their family reunions in the middle of the aisle for some reason, and you got to fight them off to try and get to the bread. So my guess is that it's already a lot less stressful and easier. And then listening to music just makes you that much happier and less stressful. So you probably are like, yeah, let's buy this after all. Why not? On Saturday, when you're fighting the crowds, you're probably more interested in just getting out of there as fast as you possibly can. So I'm guessing it's less stress, plus the music juices the better experience. That would be my guess.
According to the article, I guess the idea is that music makes people feel better when they're depleted, and it often encourages them to keep shopping. So during the week, they're a little more depleted. But when Friday rolls around, they're already relaxed, so music doesn't have much of an effect. But this is where the marketing industry kind of creeps me out. I feel like the marketing industry is kind of like the Men in Black, and they know all this stuff that I don't, and they're influencing me. They're pulling the levers, and this is where I like to know as much about marketing as possible because I want to know how I'm being controlled.
I have to agree with the study. I think that the music does have an impact on people's buying decisions Monday through Thursday because there was the control group that had no music on Monday through Thursday, and there was a meaningful difference in the buying behaviors of the customers. So to Drew's point is that the marketing geniuses have figured out how to get you to spend more. Now the question is, what are they going to do to try to get us to spend more on the weekends?
I'm a little skeptical. I think it has to do more with crowds than anything. If you're getting Costco on the weekend, you don't want to spend any more time in there than you absolutely have to. But you go on a Monday afternoon, you're able to spend a little bit more time looking around, and maybe you pick something up that you otherwise wouldn't if there was a bunch of people there. So I think it has to do more with crowds than it does actually music. I think that's just correlation without causation. All right. Number 5 here. You may have noticed that baseball is amid a rare public honeymoon okay, sorry, I copied this right out of Jason Gay's, so this isn't me actually writing this, but so you may have noticed that baseball is amid a rare public honeymoon as the flabby old pastime is getting praised for the drastic steps to accelerate its pace of play. Early numbers are impressive. The average 9-inning baseball game in 2023 is taking just 2 hours and 38 minutes, nearly a half hour less than last season's insufferable average of 3 hours and 3 minutes. This is due to the 2023 rule change that adds a 15-second pitch clock, which keeps pitchers focused on their next delivery and the formerly fussy hitter. So the pitcher has 15 seconds, and the batters can't do all the stuff with their batting gloves and stuff like that. So how do you feel about baseball adding a pitch clock and things to try and speed up the pace of play?
So just talking about pace of play changes, I think by and large, they've been positive. For the most part, I don't think it was a problem to begin with, but there were always a handful of pitchers or batters that really just abused the unlimited amount of time. Batters calling time 2 or 3 times per at bat for a 3-pitch at bat where they strike out looking, come on, let's get moving. I think in general, they've been positive. I didn't think a 3-hour baseball game was that bad, but 2 hours and 40, not too bad either, especially if you're going to the game live or there's a later start time. You don't have to stay up till 11 o'clock to finish watching a game.
I'm out of time.
I believe it's a good idea for professional sports, particularly with a large TV audience.
Yeah, anything you can do to speed it up a little bit is fine with me. I just watch the highlights on YouTube anyway, so it's not that But yeah, I'm for it. All right, I beat Joe by just a couple of seconds here. So
I was secretly rooting for you.
Yeah, I was just gonna shut up then, just so I could.
How the mighty have fallen.
Yeah. Yeah, we had
the
to
streak has been broken.
Yeah. We had to add our own pitch clock to the show just to keep the time down.
Yeah.
Next week I'm going to be the moderator.
Yeah, you want to be?
Yeah.
Do it. All right. All right. That's it for episode 88. We'll see you again next week.
All right.